Hello everyone, welcome back. My name is Arias, and today we're going to be talking about earnings and news from a whole bunch of my favorite companies out there over the past few weeks, including Invitae, Lemonade, Latch, Recursion, Ginkgo bioworks, and of course Arcturus Therapeutics. Lots of these stocks are down after earnings, and I'll tell you if I think this is justified or just Wall Street misunderstanding these great companies. Don't forget to like and subscribe if you enjoy this type of content, and leave any video suggestions and feedback in the comments below. And without further ado, let's get into it. The first company we'll be talking about today is Invitae, and it has been destroyed after earnings, down about 25% as of recording, and off about 65% from the 52-week high, with a little more than $4 billion market cap. This drop is primarily being attributed to misses on both EPS and revenue, as well as lowering their full-year guidance back to the original guidance, citing unusual seasonal headwinds. I think this is a classic short-term problem that Wall Street loves to overreact to, and while it's painful in the short term, it just gives us a chance to average down. From my point of view, this change is of little importance as they reiterated their long-term revenue guidance of greater than 50% year over year for the next few years. They have plenty of cash in the bank for now at over $1.25 billion, and while they're burning over $150 million a quarter, they have big backers that would be willing to inject capital if they were ever seriously in danger. They also said that they expected this to be the peak of their capex growth rate, and they expected this to come down in future quarters. They reiterated their mission to bring the help of genomic information to everyone, which I think has massive fundamental value. They also revealed a new so-called dashboard of key business drivers and did a deep dive into the cancer business. They envision a full stack of risk assessment, detection, therapy selection, and personalization, and recurrence monitoring, all with Invitae. They also said that they would start to assess their entry into this cancer screening space in 2022. This space, which is more often referred to as liquid biopsy, has massive potential over the next decade, as detailed by ARC in their annual report, where they refer to it as such. This changes nothing about my long-term view of Invitae, and I'm still buying more today. Next, for some of the most exciting news, Lemonade is acquiring Metromile. And while the market clearly didn't like the deal, as Lemonade is down in the low 50s after hitting the high 40s, I, however, really like this deal. The deal values Metromile at about $500 million, which is down to about a third of their SPAC price from just about a year ago. Metromile has about $300 million in cash, which means that this deal could be looked at as a capital raise for $300 million at around $60 a share, which admittedly isn't the greatest price, plus Metromile. Metromile brings $100 million in IFP, which if you take out the cash in the deal, then Lemonade is paying 2 times sales, and that's pretty cheap. However, Metromile isn't without its problems. They are burning about $100 million a quarter, and growth has been lower than investors' expectations. The best thing to come from this deal by far, though, is how much Metromile will accelerate Lemonade's foray into car insurance. The most tangible benefit is the car insurance licenses that Metromile already has in 49 states. While only currently operating in one state, Lemonade has stated multiple times that the biggest uncertainty in the rollout is the regulatory barrier. This will allow them to alleviate much of this burden when the deal is completed in the first half of 2022. However, the biggest impact will be in all of the billions of miles of well-textured data, as well as seasoned algorithms that are extremely good at pricing risk. A quick story to give you an idea of this is in California and all over, during the pandemic year there was much less driving and therefore less accidents for insurance companies to cover, and therefore insurance companies profited big. However, California regulators deemed this unfair and calculated that insurance companies owed their customers back 17% of their premiums. However, Metromile's algorithm had already calculated this factor and already lowered their rates by 16.2%. Pretty accurate. This is a sign of just how good Metromile's pricing algorithm is. This will be used to accelerate Lemonade through the difficulties that come with launching a new business line. These algorithms take a long time to create, and while they're being developed, money is lost and loss ratio suffers. With this acquisition, Lemonade can accelerate the process of seasoning their algorithm. While there will be no doubt tweaks and changes between the two business models, this acceleration of Lemonade Car will help keep the business in a healthy place going forward. Lemonade will continue to grow its customer count and premium customer and thus revenue growth, and this deal only accelerates that. Before we move on from Lemonade, let's take a quick look over the financials from Q3. All of these comparisons will be in year-over-year numbers. Their annualized IFP was at about $347 million run rate at the end of Q3, up 84%. This was made up of an increase in premium per customer of 26% to $254 per customer. An interesting note is that they said that on the earnings call, 80% of this increase is attributable to bundling and cross-selling and not to raising prices on consumers. They grew customer count to 1.3 million, up 45%. The only bad number from this report was a gross loss ratio of 77%, which is up 5% year-over-year. They said the primary driver of this was new businesses becoming a larger mix shift. However, each of these new businesses' loss ratios were improving on their own, and thus this should get better as time moves on. This all adds up to gross earned premiums being up 86% for the third quarter. They left their IFP guidance for the end of the year unchanged at about $380 million in end-of-year IFP. In addition to this, once the merger is complete, will be about $120 million in IFP from Metromile. Together, that makes about $500 million million in total IFP. If Lemonade is able to compound that at a 40% year-over-year rate for 10 years, this will yield about $14.5 billion in IFP, or at a 50% CAGR, that would be almost $29 billion in IFP. These will both obviously lead to massive gains. Despite the recent drop in criticism of the deal, I still really like Lemonade and would be interested in picking up more, significantly below my cost basis, and about the mid-40s. Now let's move on to Latch, which continues the theme of the video and is down to all-time lows as of recording. The biggest drop came about a month ago after an analyst downgraded Latch, citing short-term supply challenges that are slowing down new apartment construction, causing Latch to lose out on revenue in the short term. Again, I see these problems as much shorter term in nature than would be cause for concern. I see in the worst case that the story is pushed back 1 year and adoption is slowed, which is not great. However, if Latch is going to be ultimately successful, this is not worth as precipitous as a drop, as there is still a strong case for the business to grow going forward. Now, in their earnings report, they actually raised their bookings guidance by about 25 to 30 million and now expect full year 2021 bookings to be between $355 and $365 million, up 115% year over year. This is a significant acceleration from their $308 million, which they projected in their original SPAC presentation. Additionally, while they did not lower their expectations for 2021 adjusted EBITDA loss, their guidance is still higher than their SPAC projections. If they're able to continue to execute better than their SPAC projections, that would be an extremely bullish confirmation for the company and the story going forward, and I will look forward to comparing these results in the future, especially as more tangible revenue starts to be realized. Moving on to Recursion, which is also at the low end of their 52-week range. However, it's recently bounced back and is not total rock bottom. They've had a bevy of positive developments. They have recently received Fast Track designation for REC 2282 and expect to enroll their first patients in a phase 2-3 trial early next year. They have received Orphan Drug designation for REC 4881 and expect to enroll patients in a phase 2 trial in the first half of next year as well. They are also advancing REC 994 and will start another phase 2 trial early next year. They are still, of course, advancing their first programs in fibrosis with Bayer as well. This is a view of what programs they currently have in the pipeline. With the commencement of multiple clinical trials next year, expect spending to ramp up significantly. As investors start to realize this, it may be the true reason for this precipitous drop. However, this is just another step on the road to success for Recursion, and I am excited to see them continue to develop their business and see if Recursion OS can live up to its promise. Now let's move on to the only stock that I was slightly disappointed with in this earnings cycle, and that is Arcturus Therapeutics. Pre-earnings, the stock dropped on news that Pfizer had developed a pill that greatly reduced COVID death rates. In my opinion, it's not a terrible reason for the stock to drop, considering that it may reduce the need for yearly boosters. However, Pfizer is charging the US government $530 per course, making it much less cost-effective than a vaccine, which is going to sell for less than 1/10 of that cost. On to the results. They have completed enrollment of a combined Phase 1, 2, 3A, and 3B trial to test Arcturus 154 in Vietnam. They also initiated a non-inferiority study to compare 154 to the AstraZeneca vaccine as another way to validate their vaccine to get approval in Vietnam. This means that they now have 2 ways to obtain approval from the Vietnam Ministry of Health, which they are preparing to submit an EUA for ARCT 154 in December, with expected approval to come in Q1 of 2022. And while it is good news to see that they are progressing along and that there have been no major setbacks, before it made it seem as if potential approval was coming in December. Now that has been moved back to Q1. The original timeline to get ARCT 021 approved was for December of 2020 and then spring of 2021, and clearly this has been further delayed, as it's now the end of 2021. But while these are frustrating developments, they remain on track for success, and as soon as they get approval, I anticipate hundreds of millions of dollars of revenue and profit to hit the bottom line. Once this outcome becomes clear, I anticipate the stock doing much better. As for now, I will continue to hold on to my position as we get closer to this approval every day. Finally, the only bright spot in my portfolio this earnings season, outside of Tesla of course, is Ginkgo bioworks. The biggest key performance factor in my opinion for Ginkgo is the number of programs that they have succeeded on, and there have now been 8 products produced at scale, a number that has doubled in the past year. They have had 61 total active programs in 2021, and also added 10 new programs in Q3 to go along with a number of other tangible successes. Here are just a few. Aldevron commenced production of vaccine capping enzyme using Ginkgo's engineered strain. Motif announced their first 2 products. They received a milestone payment from Kronos as they hit their first target, and also announced that they've hit their second target with Kronos CBGV. The associated payment of Kronos stock will be recognized in Q4. Also this quarter, they said that there will be a change in accounting where they will be no longer breaking out downstream revenue from foundry revenue due to client privacy issues while they're still in the early stages of their company. Additionally, they hired an independent law and accounting firms to look into their books after the short report that was released this quarter. They found nothing that needed to be materially changed, and this was of course excellent news. However, they are still cooperating with the DOJ officials with their informal inquiry. In conclusion, Ginkgo's story is being validated with every target they hit and every product that is commercialized, and there are plenty of targets that have been hit this quarter. If they continue to have success, I think they will thrive going long into the future. Thanks for watching. What do you think of all these earnings? And I have a couple questions for you. Will Lemonade's Metromile acquisition be successful? Can Invitae bounce back? Is Arcturus still on track for success, or are they lagging? Most importantly, did you like a mashup video like this covering all of these earnings separately? Let me know in the comments below. Don't forget to like and subscribe. It really helps out the channel. My goal is to get to 1,000 subscribers as soon as possible, and I'd love to have you along for the ride. Thanks again for watching, and have a great rest of your day.